This podcast is for informational and educational purposes only and should not be construed as investment, tax, or legal advice. Any examples or frameworks discussed are general in nature and may not be suitable for all investors. All investing involves risk, including the possible loss of principal. Past experiences and planning approaches do not guarantee future results. Every day, I come across an article saying that all white-collar workers are going to end up in a hopeless wasteland where they can never get another job and their skills are basically useless. Now, I can't say with any certainty whether that's going to come true in the future, but I can say for now, some of us are pretty safe, at least when it comes to comparing against the general free tools that the masses tend to use. So what I did was I ran an experiment with Claude to see how well it would do at replacing me as a financial planner. And I started with a simple prompt and just let Claude lead me down the financial planning landscape. So the initial prompt was, I just sold my business for $27.5 million. I need help building my financial plan. Can you walk me through the steps and give me recommendations? I want to include investment selection, insurance, planning for my 2 kids, tax planning, estate planning, and making sure my wife and I have enough money to live on until we die. We're currently 40 and 38 years old. Feel free to ask me any questions you need to know to give me the best possible advice. So I chose these parameters because I wanted the amount to be substantial enough that most types of planning strategies would be applicable. And I wanted the family dynamic because this is the Wealth and Family podcast. Also because I wanted to increase the importance of next gen planning. So I kept it brief and open-ended so that Claude would have the freedom to take the conversation wherever it wanted. And then after that prompt, Claude responded with 6 clarifying questions. How did you receive the proceeds? What does your current financial picture look like outside the sales proceeds? What's your rough vision for the next chapter? What was the structure of the business sale? What state do you live in? And what's your current household spending? Or what lifestyle are you hoping to fund? So I answered these questions, and these were actually presented with pre-printed answers and one open-ended type your own answer slot. And then immediately after, I started going into planning mode. Recommendations flooded my screen. The answers I gave were short and lacked nuance. And instead of Claude asking more probing questions, it simply went into recommendation mode. And that was the first sign of weakness that I saw. I would expect a human to be much more comprehensive in their approach before they even thought about giving specific advice. Now, granted, some of Claude's advice was tempered by recommending visits to other professionals like a fee-only RIA, an attorney, and a CPA. But this quick to recommend line just would not fly in real life. So when it came to the immediate tax consequences of the business sale, Claude showed some restraint and good judgment, including that I not move out of California just to avoid state income tax. But it also made some organizational mistakes in how it presented the information. Like it suggested that I could use qualified opportunity zone investments as a charitable tax strategy. Then it jumped into retirement income planning. And based on the parameters that I gave it, it assured me that my spending would be extremely unlikely to be jeopardized because I was starting with such a large after-tax cash balance. And while I agree on the surface, I have no idea how it supported this advice. And I decided not to dwell on that part because I felt like there are bigger fish to fry, but it's something that I would be concerned with if I was doing this in real life. So next I moved on to the investment strategy where it recommended this framework. And I'll preface it by saying I don't endorse this framework. This is not something that can be applied to everyone. Everyone should look at their own situation based on their specific circumstances. But this is what it told me to do. Then this portfolio structure is based on a few realities. You don't need to take excessive risk because you've got a lot of money to invest, but you do need to outpace inflation over 50 plus years. So it gave me this general framework like 5 to 10% in cash, core portfolio of diversified equities and fixed income, like 70 to 75%, alternatives 10 to 15%, and then 5 to 10% in charitable / estate, which it categorized as donor advised funds, irrevocable trusts. It's interesting that it made that an investment allocation because it isn't an allocation. It's just a way of holding the money. That's something, if you aren't aware of the nuances, you might think that is advice that's good to go. There's a lot more to it than what it put in the headlines. So it cited its investment philosophy as being rooted in tax efficiency, asset location, reducing concentration risk, and then exercising caution with the people I choose to work with. It recommended a fee-only fiduciary in the form of an RIA and warned me to be cautious of people pitching complex products such as private placements, indexed universal life insurance, and non-traded REITs. So it was reasonable to recommend exercising caution, but it was incomplete because it didn't mention any of the nuances of any of those categories that it just threw a blanket over saying to be cautious. I would want it to have much more supporting detail, which you could ask for as long as you know to ask for it. So then it broached the subject of planning for my kids. And here's where it made a few mistakes. It suggested UTMA accounts despite not knowing what my goals were with my kids. And then it also incorrectly determined that the assets transferred to the kids at 18 or 21. But I already told it, I'm in California, and in this case, you could be as old as 25 before you actually receive the money if you structure it properly. It also warned me that the current federal estate tax exemption was set to sunset in 2026. So apparently it's making its recommendations based on a date prior to July 4th, 2025, because the entire framework that it based its recommendations off of is now much different. And in fact, as a side note, I've yet to see Claude, Gemini, or ChatGPT accurately cite the new rules as they relate to estate tax exemptions. And as of today, it's been 9 months since these rules changed. But for some reason, can't figure that out. None of them can. Anyway, back to the work product. Claude transitioned from there to broad estate planning. And it brought up some key priorities and ultimately just stepped back and recommended that an estate planning attorney handle all this. Finally, it touched on insurance planning, which it summarized, and it made some pretty good high-level recommendations. And then it laid out a 90-day implementation plan that seemed pretty reasonable and basically delegated all the important decision-making to other professions. Now, this was all well and good at this point, but I really wanted to see what would happen when I let Claude have some real decision-making power. So I asked it to dive deeper on the investment allocation and explain that I didn't want to pay an investment manager for the core portfolio. I wanted to execute it myself and reduce the fees. And then I asked for a specific plan, including the exact investments, the percentages, and then a schedule for purchases. So then it gave me the breakdown of all of the investments that it selected. And it chose 6 exchange-traded funds. I appreciated the simplicity and the tax efficiency and the fee awareness of the recommendation, but it missed one crucial step. It never asked me about my risk capacity or my risk tolerance. It just simply jumped right into a recommendation with no supporting evidence. Now, I'm aware enough to know why this is a problem, but it's easy to conceive of a user just taking this advice and running with it without a second thought. And while there's nothing egregiously wrong with this on the surface, in terms of the exact recommendation, I did find that Claude's assumptions were pretty presumptuous. And more glaringly was the recommendation of California municipal bonds, which are tax-free in California. It cited my 50% tax rate as the reason, except it failed to account for the nuance that tax rates change if your circumstances change. And I already told it that my business sale pushed me into a much higher tax bracket, but it assumed that I'd be flying high for forever. I thought it was way more reasonable to assume that the tax rates would drop dramatically in the immediate future, but Claude didn't give any indication that this was under consideration. Also, the only other bond recommendation was a short-term treasury fund. So longer duration funds were totally ignored here. And what I mean by that is the fund had a longer holding period and greater interest rate exposure in terms of how volatile the underlying value of the fixed income would fluctuate. So it provided a brief explanation about wanting to avoid poor bond performance, which was experienced recently in 2022, but it didn't provide any further help beyond that. Ultimately, it left off with you can always extend duration later as you get more comfortable, which means that I'd have to revisit this in the future. And I suppose that if I kept returning to Claude in the future, I could get more specific guidance on the bond allocation in the same way that you talk to a human advisor regularly. But if I had interpreted this as like a set it and forget it approach, then I could really get hurt in the future. Bond allocation aside, I pressed on. I wanted to maintain my veneer as a novice, so I wanted to get Claude to add more detail to its reasoning. I pressed on to why it chose 45% for US equities instead of 40% or 50%. And it explained that this wasn't scientific in any sense, but just a reasonable and defensible approach based on spending and risk tolerance, which again, it never asked me about. I thought the reasoning was decent, and it actually created this cool like toggle slider chart to let me visualize the impact of the inputs so I could see what my median balance would be, worst case scenario balance, failure rate, worst single year, and I could dial it up or down to see what annual spending and equity percentage allocation would do to those figures. And then finally, I moved on to the tax planning component. It originally sent me to find a CPA to get my answers, but when I turned around and asked again, I wanted to see what tax planning strategies it would actually recommend. And it didn't explicitly tell me to do anything even after I pressed, but it did suggest some specific different options. And then it actually included when it would likely come into play and then ranking them based on the impact that it would have. So this was a list of things like maximize tax shelter accounts, tax loss harvesting, asset location optimization, owner-advised funds, capital gain realization timing, Roth conversions, 529, super funding, qualified opportunity zones. It also flagged my specific tax rate assumptions. Seemed reasonable on the federal level, but for some reason it couldn't get past the assumption that my tax rate in California would be 13.3%, even though that only kicks in with over $1 million in income. So this all took about 45 minutes, and I got a ton of suggestions back, and most of them were rooted in facts, even though Claude failed to incorporate the newest tax laws. The high-level recommendations were reasonable, but Claude failed to incorporate the nuance that a good human advisor would likely do. And then my final ask was to produce everything we discussed in a single document. And in just a couple minutes, I had a 16-page document outlining my full fake financial plan. And it was beautifully written, even with its inaccuracies. And I felt like someone could take it and execute it. But the key point missing here was that as your life evolves, you'll need to adjust the plan. And the question really is, can you keep coming back to Claude for advice and expect it to be reliable? Can you expect it to remember everything about you? Can you expect it to hold itself accountable and ask you the right follow-up questions? Because if you don't know what to ask it, then you're not going to be able to quarterback your own financial plan. It's really just a simple case of you don't know what you don't know. So maybe one day some general AI tools will be able to craft something like this, but I'd say for now, the financial planner job is safe.